being a good investor is not so much about seeing where the business is today. It's really dreaming about where the business can go. And,
Sure.
Finance often is looking back. And so, really what it comes down to at the earliest stages for founders, do they understand the investments they're making? Do they understand really the ROI needed?
Hello and welcome to the Growth Minded CFO. I'm Lauren and this is Alex. And Alex is a fintech CEO and I am a fractional CFO. And on this show, we speak to finance leaders about what it means to be a growth minded CFO. Finance is not just a backroom function. It's so much more than that. And we've searched out some of the best in the business to learn about what the true role of a CFO really is. Joining us today is Nick Wijnberg. Nick is an ex-Wall Street / Main Street banker turned company builder. He's led the finance function for Ride Panda, is a passionate investor in the digital and automation revolution as a general partner at Lorimer Ventures. We're so excited to get his perspective as an investor and a CFO. Nick, welcome to the Growth Minded CFO.
This is such a pleasure to have you on the show today, Nick. Thank you so much for being here. We've worked quite a lot together, and I've always been super impressed by your experience, your background, and what you could bring to this the finance background that you had, like how this could bring like a different perspective on like how we work together. So I'm super grateful that you could join us today. So thank you so much for joining us.
Thanks for having me.
Would you mind just introducing yourself and how you became that amazing CFO?
Sure. Yeah. So I've always been an investor. I think the first time I got addicted to the markets was actually my senior year in high school. I was a tennis instructor and I saved $5,000 that summer, which was an insane amount of money for me. And I basically put it all into Apple. And whether it was lucky or smart, that has still been one of my best investments I've ever made to date. And I thought I was a genius. And so throughout college, I was like, oh man, I'm hooked on this Wall Street thing. I did everything I could to get a job out of school that was trading. So I started as an equity derivatives trader. I moved into structured credit. I really loved credit, but got pretty burnt out on markets. It was basically 3 days with no vacations and crazy hours. And I was like, I'm not fully cut out for this. I really like credit. So I decided to pivot a little bit. I actually moved out to Denver, Colorado and became a commercial banker. I used a lot of my understanding of derivatives to start doing a lot of asset-based lending, kind of pivoted again and went into project finance, really understood a lot of sort of the ins and outs there, and then sort of continued my career with large corporates. And all the time, I really loved the stories. I think the whole reason why I got interested in investing is because I really love the stories, trying to sift through the numbers, but really try to figure out the story before anybody else. And as a banker, I felt like a little bit of a commodity. Ultimately, I didn't have the full skin in the game that, founders and operators had. I felt like I had a lot of advice to give. I decided, I need to do something more. So I started, in 2017 as kind of an angel, trying to figure out I don't quite have the stones to be an operator, but maybe if I put a little skin in the game, I can be a little bit helpful. And, started really trying to figure out what was my edge? Why would people want me as an investor on their cap table? And I realized I could bring a lot of my experience as a banker to founders who, maybe didn't have that sort of finance background, but really wanted to professionalize their business to talk to other investors, potentially talk to other lenders, and sort of the public at large. So that's sort of how I slowly became an investor, in venture. And then I realized, hey, as an investor, maybe I can make this a little bit more formal. So it started as an advisory role and then became more formalized as a fractional CFO, and then really as a full-time CFO, bringing all the experience I had as a banker, and then experience as an investor.
So that started. So the sequencing is investor and then CFO, right?
Correct.
Okay, I thought it was the other way around. So that's super interesting.
Yeah. I was a banker for 10 plus years in lots of different industries, spent a lot of time on the other side of the table, kind of critiquing financial models, critiquing CFOs, trying to find reasons, to say yes or no. And I'm bringing that sort of experience as a CFO, knowing how to talk the talk to other bankers today.
That's such an interesting transition because so often we kind of see it go in different directions, whether you're going from founder into finance or you're going back and forth. As you made that transition and actually working on the company side, what did you kind of find was different? What did you learn? What were the surprises?
Oh man, I mean, I think so. Lorimer Ventures was started really as operators helping operators. We first started as a syndicate and now a fund, but really we're made up of people that have done it before. And to be honest, I had sat at the lending side. I hadn't, being an operator is incredibly challenging. It's really every job you have to do it. Like it's not, you can't be siloed into one function. If there's something that needs to be done in ops or, like Stefan, my partner says, if you need to clean a bathroom, you do it. Even if you're the CFO, titles don't matter when you're a startup. So I still wanted that. I always wanted to understand what it meant to be an operator. And so that's really what drew me into working as a CFO is like, I feel like I have more to give and I want this experience. I really feel like the empathy, the understanding, the ability to get to the second level conversation with the companies that I was investing in was so important to get to that speed of trust that I had to have that experience.
Yeah.
So I was just looking for any opportunity to get that experience so that when I had conversations with companies that I would invest in, I could get to that second level pretty quickly and I could empathize, rapidly.
Yeah. So what was your first kind of like foray into that operator experience?
Yeah. So, I mean, I had been advising startup companies since 2017, as a CFO advisor. So
Got it.
Founders would come to me, maybe they are post-revenue, but just marginally so. They had not thought of anything around building a financial model. How do they present it potentially to non-dilutive capital? So I started really as an investor advisor. And it wasn't until I saw some head of finance roles pop up in some of the companies that I'm advising that I talked to the founder and said, hey, would you consider bringing me on? I would love to do this. And, it helped me, hit the ground running. And so that's kind of how I started to transition.
Got it.
Ride Panda was really the first, real full engagement, everything, all in that I've had. But I continue to advise a lot of our portfolio companies, building models, talking to, debt providers, other investors. And so it's a pretty nice portfolio.
And would you say that like having done that, like this kind of experience as a CFO within a portfolio company, would you say that like this has helped you? Like
Tremendously. I mean, look, I think that a lot of investors have a bit of an ivory tower element to them. There's investors that have been operators, but they're so, departed from that now as investors that they don't understand what the newest, FP&A tooling is, what the newest HR tech is, who the up and coming private debt providers are that you can talk to. What are some of the new things going on with accounting that have changed in terms of software technology? There's lots of changes that goes on. And if you're not a player coach in this environment, particularly in the pre-seed and seed, you really have you really are of a distant perspective and you don't really, really understand and you can't bring empathy. I think with Lorimer, we don't have a big brand name. So we had to earn the right to be that first call for founders. And to earn that trust, you really have to be in the trenches with them and to empathize. And so that's really how I felt about it, which was, how can they think that I can empathize if I've never been in their seat before?
Sure.
So I really felt like I had to go and get my hands dirty in order to, be in the trenches with the founders that I want to back.
Yeah, that makes so much sense. I think often as a CFO, when you're working with investors, there's such a difference between investors who've had operator experience and those who haven't. And there's that empathy. There's also sort of alignment of goals and sort of what's reasonable given the business model. There's really just so many advantages to working with someone who knows what it takes to run a company.
Agree, 100%.
Yeah, and I think something that resonates a lot as well in what you say is also like this sense of not necessarily cleaning the bathroom, but just in general, like having a real sense of reality. I think that's something that like as a founder raising money, you 100% see investors that have never been like in the trenches just because, and I remember I have been a banker before as well, like spending nights, adjusting like a little parameter in the model where you're just actually missing the one big thing that is actually about like, am I going to get to PMF? Am I going to get to, and having like this kind of like, dual lenses of like saying, yes, I understand this is important, but I shouldn't miss like the other like operational elements of your company, especially if you're investing pre-seed and seed where it's usually like pre-revenues, right? Where there's still like so many things that are like totally uncertain. It's probably making a big difference. So that's super interesting.
Spanning both roles, I'm so curious to kind of explore this kind of connection between CFO and investor. So I'm curious, as someone who's done both, as an investor, what are the sorts of things that you're looking for in a startup you're potentially going to invest in that a CFO can impact, right? I know there's the financial model, obviously. Are you looking at, the financial operations? Are you looking for certain green flags? What can you kind of tell that CFO who's helping support that fundraise?
Yeah, I think that being a good investor is not so much about seeing where the business is today. It's really dreaming about where the business can go. And
Sure.
finance often is looking back. And so really what it comes down to at the earliest stages for founders, do they understand the investments they're making? Do they understand really the ROI needed for that investment? And it's very, sometimes it's very simple at the earliest stages, but as it gets more and more complex and founders have raised capital, oftentimes Lorimer has invested after another institution has come in. So
Sure.
oftentimes they have some cash already on their balance sheet. Do they really understand where to put that? Do they really think about the return needed for those investments? Part of it is building unit economics. I mean, we can invest in companies pre-revenue, but they really need to have an understanding of what the revenue model would be.
Yeah.
And I'm happy to give some feedback and understand and ask some questions about margins and stuff like that to just see where their head is going.
Yeah.
I definitely don't think when we invest it needs to be all right, but we just want the founder to have thought about these things.
Yeah.
And oftentimes the finance is kind of like, don't ask about it, put it away. It'll sort itself out. I'll hire that function when I'm a Series A or Series B and let me just build. And I totally respect that. And I think that's absolutely right. But I still want to be that kind of the good angel on your shoulder being like, I agree. But like, let's think about where this is in 5 months, 6 months. And, what are the unit economics look like? Have you thought about the go-to-market strategy, the cost of acquisition, all this stuff? Yeah. So it's really more just asking the questions than having the right answers. And I think it's just having that perspective to ask those questions is really helpful for founders at the early stages.
That makes so much sense. It's not always how we think about finance or finance as a function. As you mentioned, a lot of financial operations is about historicals. Mm-hmm. So what I'm sort of taking also from what you're saying is this kind of mentality of forward-facing finance, thinking about the return that's going to happen from the investments you're making and taking that mentality, which is really, it makes so much sense.
That's the difference, I'd say, CFO advisory at the earlier stages versus a late stage mature company when you can really look at historicals and dialed into the future. I mean, it's so variable that it's more forecasting than anything at that point.
Yeah.
It's super interesting because I think you've seen by investing pre-seed and seed, usually no finance team, right? It's usually the founder who would be doing a bit of finance when there is a bit of financing. Right. What would be your advice in terms of to those companies on when is the right time to start having a proper finance function? And I understand that sometimes it might be with same as Lauren with a fractional CFO. Sometimes you internalize it. What is your piece of advice on this one?
Yeah, so I think early days, you need to figure out a bookkeeper and you need to find tax. So I think depends how you want to do that. Do you want to find fractional bookkeeper, fractional tax, and then get the CFO advisory? Or do you want to hire somebody that could potentially be in-house bookkeeping, in-house maybe a little bit of tax advisory and the CFO? Normally I see companies find that fractional bookkeeper, have a tax team that's already assessed, but that next level, which is, okay, how do we prioritize investments? We've now come close to raising capital. I would say typically it's after you've raised, $500K to $1 million and when you probably have, hopefully 12 months of runway. That's when you really, I think, need to be starting to think, even on a fractional basis, how do I build out my next 12 months? What am I going to spend on? When am I going to hit revenue? What are the margins going to be for that revenue? So I would say really it's right around when you're starting to actually generate revenue. Should you be talking to a finance person about strategy there? I think, at the earliest stage, you can have somebody that's like a slight advisor that can eventually become a full-time role. I think that's the best of both worlds if you could find that. But I would say earlier than later, I do see people build great businesses that don't have a finance function and the profitability, or they run out of cash sooner than they thought. And even though it's a great business, there's some other problems under the surface that I think a finance person earlier could have helped. So maybe I'm talking my own book as a finance person, thinking I'm more important than I really am, which is totally fair. But I definitely see founders, who think about it earlier end up being a bit more on point when they have those investor conversations, and it's just helpful. So I'd say sooner than later.
Totally agree. I'm curious because you are serving as a fractional CFO, which is both an execution and advisory role, and you're serving as an investor. In having both of those roles, are you doing the CFO role as you're investing? And if so, how do you kind of balance those two roles? Do you have to kind of put on your investor hat and take it off and put off or do they blend kind of seamlessly together?
So, I mean, the way that we say it is that they're all our children. So as soon as you come into the Lorimer fold, we will do whatever we can to make you as successful as possible. So typically and we try to go to work to earn the right. So sometimes we go to work even before we make that investment, but certainly post-investment is where our engagement starts. And we just want to be a helpful partner, right? We want to make you feel like the first call, whether it's right or wrong, you can call us. And so it's typically post-investment. It's typically the way I've started most of the time is like, what's your runway? And they have a kind of estimate, but they don't really know. And then we're like, okay, well, then let's start to dig into that. And I think another thing is getting ready for that next financing round, because I think one of the things investors really look for is, okay, I'll give you $5 million. Do you know how to spend it? And do you really know the return you're going to get on that spend, right? Yeah. And, those are questions that if you haven't gone through scenarios and understand, how to build that out, you don't have a great answer, and you could potentially spend it in the wrong place. And I think especially now with higher interest rates, those are much, much more critical decisions at an earlier stage. I mean, you had a whole decade of low interest rates where you could kind of make a couple mistakes because the cost of capital was so low that the threshold for what the return on the investment was much lower. But especially in the last couple of years with interest rates being higher, these conversations and these thoughts with, making sure that return is, satisfactory is more important than ever. So
yeah. I love that idea of starting kind of with where's your runway, kind of how many months, because it contextualizes what needs to happen in a timeline. I think that's such an interesting thing to think about when you're coming in as an advisor, as an investor, of like, how much time do we have? What are investments going to be? Really framing it up. I love that insight.
And it's also coming back to a point that I think was super helpful in our interactions and what you just said around not necessarily only thinking about like how am I spending the money, but also what is expected from me at the end of the current time window, which is basically my runway, right? And I think that's something that we've seen as well with like as a young founders that I did as well, which is like very, very much being focused on like how do I spend the money now, as opposed to how do I get to the point and or actually walk backwards from this is what is expected from the business at the next milestone, which is 2 or 3 years from now, and how do I need to anticipate that? And I think that's where you provided a lot of guidance for founders, and actually to myself, on this is, I think, where finance is super important, because when you're working backwards from these points, and these are the unit economics you want to have, these are the data points you want to cross, then it starts to be about finance and trying to just walk backwards and saying this is the path we should be in. So is this something that you do a lot with other founders?
Absolutely. Yeah. I mean, I think one of the things like sales forecasting, I think you think it's easy, but you're not creating scenarios. And if you just trust the ambitious goals of your sales team, which we love, how do you plan for scenarios if you don't hit these ambitious goals? Do you have, it's cliche, but if you fail to plan, you plan for failure, right? And so oftentimes I see, big dreaming, but we don't have scenarios. And so it's very much that. It's like, okay, I agree, we're going to hit rocket ship into the up and to the left, but it's never, or up and to the right, but it's never like that. It's never like that. And so you have to be able to, dial in your finances to scenario plan. And so I think that's really where finance comes in, is like, okay, everything goes right, you don't need me, but we know everything's not going to go right, right? So how do you plan for situations where it's not exactly perfect, and then you make better decisions in that way?
You just touched upon like the change in interest rates, and because I think it's something that we've all witnessed, but how like at an operational level for investors and companies, like have you seen a change in like the role of the finance function? Like has this become more important?
Yeah, I think because, the capital markets generally have tightened up, right? I mean, that's what the Fed's trying to do with raising rates, is trying to pull back risk taking a little bit to slow down, the economy and the inflation. But I think that, that impacts everybody. It doesn't matter if you're a startup founder or, a Fortune 100 CEO, you have to change the way you make decisions, and you have to change the way, like I said, the expected return on the investments that you made. So one of the big things that I see founders that have missed it, that have operated in the low interest rate environment and now in this interest rate environment, is they continue to act exactly the same. They haven't changed. They haven't changed their spending. They haven't really changed their business at all based on the change of cost of capital. And I really think that's maybe not the right approach, because I think that you have to play the cards that you're dealt. With the higher interest rate environment, cash is more important now. It's a higher. That means that you really need to be smarter about your spending. You're not going to be able to raise the round as easily as you did in 2020 or 2021. So you need to figure out, how do you get to those metrics that you're talking about where you are sort of backable. Also, I've seen the rise of venture debt because of equity has really tightened up. Venture debt is much more focused. As a former banker myself, those sort of financial metrics are way more important. To be able to show it allows you to get capital, continue your business to grow without having to deal with sort of venture capital.
And beyond the sources of funding, would you say that the CFO or the finance function in general has moved from, a kind of a, not necessarily back office, but like less important type of position because, anyway, the money was unlimited to, well, actually like you need to be front and center because this is like a critical piece of like us running the business.
You're in every room, right? You're in every call now. When you're making a hiring decision, you're really trying to understand, okay, is this the right time to make that decision? When you're setting up sales forecasting, you're understanding, okay, now you're empowering your sales team. How much are you going to spend to acquire that customer? Is the CAC to LTV? Does that make sense? So I think now where you maybe were sitting in a back room just making sure the financial statements came together, and today you're in every room and you have a voice, and I think it's a relevant voice. It shouldn't be the loudest voice, but it definitely needs to be one of the voices in the room to give perspective, pricing, all that stuff, everything. You should be in all the conversations.
And being finance professionals, right, we kind of feel that like this is the right way to do, right? Like even in a low interest rate like environment, if that comes back again, it should stay, right? So it should. And what is do you think it's going to be the case, or is this been like kind of a thing that will stay in this kind of environment for the role of the CFO?
Well, I think it very much depends. I would love to say, I'm biased. I would say I think I would love to be relevant all the time. I definitely think it's more relevant the higher the cost of capital. If we ever go back to zero interest rate environment, again, investing was very tough in that period because everybody had cash, and it's really hard to make decisions that were really measured because you had to act really fast. So I think that the lower the interest rate environment, the faster you have to act, which means sometimes our voices don't get as heard. So I would say that, the higher interest rate environment actually gives us a little bit more time to breathe, to evaluate things because it's more meaningful of a decision. I would love to say that we're building these muscles where it doesn't matter the interest rate environment. And so my heart says, yes, we stay in there, but my head says, the higher the interest rates are, the harder that it is to capital markets, the more relevant the finance function.
Yeah, it makes so much sense. I feel like when you work with startups long enough, you kind of notice that they almost always gravitate to what is practical, right? Because there's so limited resources to do anything that there's kind of ruthless prioritization. And so when the cost of capital isn't high, why would you focus on something that isn't a direct path to your end goal, which is growth and which is market dominance and all these other factors? So I also wish that the finance function would always remain as relevant and as sort of the focus. But I also see that push-pull of the startup industry where it's so much about just what's necessary now.
Yeah.
I'm curious, in this tougher environment with higher interest rates and also just funding being a little bit scarcer come by, equity funding, VC specifically, it's also a tough time to be a founder. And you speak with a lot of founders.
Definitely, yeah.
And you speak with them about a scary topic, which is finance. How do you manage sort of the emotional part of that conversation of getting folks kind of wrapped into a finance conversation, being heard, getting the message across, and really helping someone who's in a really challenging position?
Yeah, I mean, this is something that I'm working on. I don't think you're ever perfect at this in terms of how do you become an intellectual sparring partner, but also, not offend anybody, right? And so it's this very fine line of, I think that if you do the work, you do the homework, you show the numbers, you can get really far. I think that, the only way that, I think game recognize game to a certain degree, and founders put their blood, sweat, and tears into their business. Yeah. And if you show that you have as much passion and love and, sort of desire for the business to succeed in the work that you do, I think that's how that emotion can kind of coalesce and become really positive. I think where it becomes sort of, a standoffish or maybe a little bit not a positive relationship is where it doesn't feel like interests are aligned. And so, just as long as you keep it all in that perspective and you keep that, sort of sense that we're all in the ship together and we're, that what I'm doing is trying to help. I think that's the right approach, but it certainly has not been easy. It is anxiety inducing. People have put, their whole lives, they have children, like this livelihoods of a lot of people that are involved. And so it's a very, very tough situation. I think you have to kind of judge every founder differently and interact with them very differently. Some of them like tough love, some of them don't. You have to really cater your sort of perspective to what's the most valuable for them. But it is definitely an art and not a science. And that is why I'm grateful that I have, my partners that can also kind of edge it out. So it's like the other operators, other partners within Lorimer Ventures, they're not finance people. They are builders, they're product engineers, they are, heads of business. They've started their own businesses before. So I would say my perspective is useful, but it's really nice to have, 3 other perspectives that can kind of, soften me out a little bit.
Okay, got you.
But I think there's an interesting parallel here between the role of the CFO within the company and the investor as well, in terms of how do you connect with the people you're working with, right? Are you this kind of like cold CFO that is totally like disconnected from like the operations of the business? And the same can happen with investors, right? Like, sometimes you're just sending your reporting and you just get like a one-line answer, which is like something that's quite harsh, and you're just like, well, actually like behind these numbers, there's sweat and tears, as you said. And I think that's something that helps a lot in this case, where, to your point, is about like connecting with the people and just making sure this is not only about numbers, but also like what's behind.
Well, I think, from my experience of stepping up as a CFO, the first thing everyone's thought is, oh man, we're going to get our budgets cut. Like, oh man, like now this is the guy that's going to, wag his finger every time I use the ramp card. And like the first thing that I did when I stepped in the CFO role was like, I want to empower you. Like, let's figure out where the money can generate more revenue and let's just put gasoline. Let's spend. If we need another customer success person, to really do inside sales and increase our net revenue retention, I am all for hiring that person. Yeah. But again, it has to be driven on net revenue retention. You have to be calculating LTV to CAC for me to say, yes, I think we should spend. So, but I always start the conversation with, I want to empower you. You guys are super, I'm, helping you. You're really the stars of the show. I just want to be able to put the resources to like make you as successful as possible. And I think you have to go in there first saying, I'm not going to cut everybody. I'm not going to ask for everyone to be fired. I really want to support you. I just want to do it with data, and have a measured approach. But I think that's important because I think everyone thinks, oh, we hired a CFO, we're not going to have a ramp card anymore. And that's just not, that's not a good approach. Then it becomes that you're sitting in a corner and nobody likes you because every time they have a conversation, they need to cut their budget. Yeah. So I think going first saying, I want to empower you. Let's do the data to find where this money needs to be spent. But I am an advocate for spending and not necessarily cutting everything to the bone.
I love that reframe. Where are we going to spend? Because it's so often as a CFO, you're like the no guy. So I love it. But every no to spending is a yes to something else. So why not start there?
Right.
Such a good insight.
Yeah,
I
good
love
perspective.
That. Yeah. Welcome back to the Growth Minded CFO. So our next kind of topic we're really curious to ask you about, Nick, was the CFO being at the board meeting. We know it's kind of something where some CFOs are there and present the numbers, and others feel a little shy, a little uncomfortable being there and really rely on the CEO to do that. So curious about your kind of thoughts and opinions on, First off, what are the benefits of the CFO joining for those board meetings?
Yeah. So, I think a great CFO isn't just somebody who knows the numbers, but really can put the strategy behind the numbers and to be, like I said, an intellectual sparring partner, not only to the founder, but also to the board at large, right? And so, the CFO needs to have a perspective on where things are going and what would happen if things don't go right, what would have to change. So, not just knowing the numbers, but knowing the variables, so important. One of the things that I look at when I look at boards, board presentations or they're sent to me, is how did the budget change? What were the variables that you sent at the beginning of the year and then halfway through the year? What were the things that changed? What did you hit? What didn't you hit? Why? The CEO should know that, but the CFO should have a perspective. And I think that while, they should have all aligned voices, the CFO really has an opportunity to be another voice, voice in the room, for a perspective on where things can go and what things can change. So, I think, it's really important. I typically think of the CEO as really the dreamer. Yeah. The CFO supports the dreamer with numbers, but needs to dream as well, right? And so you need to be there. You can't just have the CEO being the only dreamer in the boardroom. You need to literally believe, show the board that there's a few other believers, and that they're coming from different perspectives, but we're all going to get to the same goal. So it's just like a basketball team. You can't just have one star. You really have to have people serving their functions, but working together. It's really a nice thing.
I love that. And as CFOs, I feel like as a personality type, we really like to prepare. Mm-hmm. So do you have any tips for if you are a CFO who's going to be brave and be in that room, how do you kind of prepare for yourself for that conversation? What should you be thinking about doing in the room?
Yeah, no, that's really tough. You have to read the room, right? So not always should you be speaking up. I think that, just being passionate, doing the prep, but being passionate about the future, being aligned with the strategy, I think empowers you to speak up. I think, that's part of the culture that I think if, founders are listening to, or if, there are CFOs that work with founders, part of that is building that culture where you feel like you can speak up and speak your mind. That's really important too. And so, the work you need to do beforehand is building that, rapport with your CEO so that they are ready for you to say what you're going to say. So you need to have had a conversation with your CEO about some of these things already. Yeah. I would not bring up a thought that you hadn't already told your CEO in the board meeting, right? So exactly, right. So you get to practice what you're going to say to the board with your CEO. Smart. You should be practicing that. You should be doing the prep. You should be kind of saying some of these things first, in a private setting, getting the feedback, getting alignment, and then feeling confident to be able to go and say it again. As a CFO, you should be asking the questions that your board's going to ask your CEO. Yeah. You should be anticipating those questions. So really, I would advocate you and, there's CFOs that sit on boards. You should be thinking as a CFO, what questions is my board going to ask? And try to anticipate some of that stuff, before you go in. Because if you've anticipated that stuff, if you've had these conversations with your CEO, invariably the question is going to come up in the board and you're going to be prepared and you're going to be ready to knock it out the park. So I think that's how you do it is, it's really having a good relationship with your CEO and your finance team to be asking these questions, to think like a board member. Yeah. And the better you get at that, the more empowered you can be in the boardroom.
I love that idea of prepping with your CEO. I feel like as FRAC CFOs, we often are helping prep for board meetings, but we're also advisors. But really, it's an interesting idea. As the CFO, full-time or otherwise, you're kind of like the closest to the mentality of an investor for anyone in the company. You're kind of the best test run. Mm-hmm. So it's just such a great idea to have kind of that pre-talk conversation and think about those questions before you get in the room. Mm-hmm. Definitely taking that one away.
Yeah, good.
And the other thing that we can take away is also the fact of being a dreamer as well. And I love that because as a CEO, you're always kind of walking a very thin line in terms of being super optimistic and seeing the grand vision of your company, but at the same time well, are we going to be able to pay for the payroll at the end of the month, and are we going to run out of money? And I think it's a difficult situation to be the only one in that position. And I think it's also super important when it comes to the CFO in front of investors to acknowledge that it's both, right? Mm-hmm. It's being realistic, it's about knowing the numbers, but it's also about embodying this vision of what we want to do and understanding that. And I think it speaks a lot to what we said earlier around understanding the business, not only understanding the numbers in some ways. And to this point, Nick, something that's super interesting because you've probably been there like a couple of times when you see companies coming to fundraise. Would you do you have any specific tips for those kind of like, especially young CFOs that probably have never, or young finance leaders where you haven't raised in the past, or you've raised a simple round? Sometimes seed round is more about like knowing the founders and there's limited data. But when you get into Series A, Series B, you need to prepare a lot of things. What are the kind of tips that you would have for the finance leaders when it comes to fundraising?
Yeah, I mean, it's literally like so different from Series A's. Like I would say pre-seed to seed, seed to A to B. I mean, I could go in a lot about different things. I'm seeing a lot of Series A's right now and B's. I would say Series A's, you need to have a few things in your financial quiver, assuming you're post-revenue. You need to really obviously have, your financials ready to go in a data room. You also, what I really like to see as a finance professional is a 3-sheet financial model. I don't love seeing just a P&L. I really, I need to see a P&L, I need to see a cash flow, I need to see a balance sheet statement. Even if you're a software business, I want to see where that stuff is going. There's also a lot of stuff around capitalization now of R&D expense. Yeah. There's stuff that needs to be showing there that I need to see that you're starting to think about it more than just a revenue forecast, that you're starting to think about it from that 3-sheet model and a little bit of sophistication. Another thing that, is when you're raising capital is, okay, what are the uses of proceeds, right? Yeah. So a CFO needs to be dialed in about those uses. You need to understand your metrics, your LTV to CACs. You need to understand, what scenarios, where the spending's going to go, what runway does it give you, really have it dialed in. I mean, I'm a homer for a model and I love a really nice model. I can't lie. And everything comes out of that, right? Headcount planning comes out of that. Yeah. Other expenses, marketing expense, all of that stuff needs to be pretty dialed. So I would start with a really detailed model. And I'll tell you, the more detailed the model is in my mind, and also your ability to forecast and hit your numbers. That's another really big thing too. Most investors you probably talked to them in a prior round. They probably said, hey, I like what you're doing, but I want to see what you're doing in the next round. Now, what they're really doing is they're taking the original model you sent them, the forecast you sent them, or even the deck that says we're going to hit $100 million in 2 years. Yeah. And then they're going to see that new deck that you said, and they're going to see what those adjustments are. Right. And so I think you need to be ready to explain those adjustments and also really prove out that when you say you're going to do something, you're going to hit it or exceed it. Yeah. You want to build a reputation for under-promising and over-delivering consistently. And I think that a lot of times founders slip up, or even just founding teams slip up, where they're constantly over-promising and dreaming is great. But there really needs to be that grounded in, okay, should I believe what you're saying or how do I discount that? So that, to me, those are kind of the intangible things where you're proving out, you build a budget, you show your historical financials, maybe you had original projections and now you have these ones today. Right. How do you adjust that? And how can I believe you as an investor that you are saying, you're going to hit what you're going to hit? Or are you going to lowball and sandbag and then always exceed my expectations? That's like a dream for me, but I want to believe that. I don't want to, so I think that as a CFO getting ready for financing, getting all that together, but getting that narrative ready, saying, hey, we projected this, we hit this, we can continue to do that. And we can prove out that when we model something, we're going to hit what we're going to, we're going to actually follow the plan and execute. And I think that's what you're proving out to investors is, can you execute? Yeah. And that's what the CFO, puts the numbers behind to show that. Yeah.
That's amazing. I feel we learned so much from having like your kind of like dual positions between investors and CFO, and that's really rare, right?
Yeah, I feel like it's super rare. It's also interesting to hear you kind of talk about the different stages and the degree of like financial discipline required. Because I'm not sure so for earlier stages, I imagine much less tends to be expected. But as soon as Series A, we're like going back and checking the numbers. We're doing 3-stage financials. We're getting serious. And it's interesting wearing both of those hats, recognizing that kind of transition, both internally as a CFO and externally as an investor.
Yeah, absolutely. You got to up level each round. It's you're getting into it's like the G leagues, to the minor leagues, to, the major leagues. You're getting there, and each level you got to level up every function.
Yeah.
Hopefully you get more and more people with more experience as we get through the stages. So that should be fine.
Yeah.
Nick, thank you so much for being on the show today. It was so interesting. I'm really grateful.
Thanks for having me. This was great.
Thanks so much.
Thank you everyone for listening to this episode. This was really great to have you, Nick, on this episode and on this show. If you like that show and that episode, please subscribe, please review us. That would be super helpful. You can also share that with any finance professional that would benefit from Nick's experience. I thank you for this episode, and we'll see you next time on the Growth Minded CFO.